What's up? Today we'll be taking a look at online retail ETFs IBUY, ONLN, EMQQ and EBIZ. We will discuss the general outlook for investing in online retail. For each ETF, we will look at portfolio composition, top holdings, cost, and performance. At the end, I'll give my own opinion. If at any point you feel like you like this video, feel free to hit the like button, because that's what it's there for. So let's get right into it. Online retail has forever disrupted the way that we acquire goods. Today, we have the largest malls and retailers right at the tips of our fingers through our smartphones and computers. Many times it's simply cheaper and easier to buy online, and there's a greater selection to choose from. Why would I want to brave a 5 a.m. Black Friday shopping stampede and fist fight people for consumer goods when I can just buy on Amazon like a civilized human being and have it the very next day? Brick and mortar retailers that have failed to generate an online presence have been on the ropes in recent years. Despite years of strong growth, e-commerce still represented less than 1/5 of global retail sales in 2020, highlighting substantial room for further adoption. E-commerce is a global theme, poised to benefit as expanding broadband and internet and mobile penetration coincide with a rising middle class in developing markets. The pandemic forced many businesses to offer goods and services online for the first time, which has shifted consumer expectations and expanded the scope of e-commerce to larger segments such as groceries and autos. And the coronavirus pandemic only accelerated the already ongoing e-commerce revolution, as people were afraid to leave their houses to shop in person and thus had to buy online. Some would tell you to sell the e-commerce stocks coming out of the pandemic, as they were labeled as stay-at-home stocks. They would say years of growth are already priced in, but others would say the pandemic only ironed in new shopping habits and there's no going back, and thus online retail is expected to continue to grow into the future. So let's introduce the ETFs. We have the online retail ETF IBUY from Amplify Investments with $1.2 billion in assets under management. This ETF contains publicly traded companies that obtain 70% or more of revenue from online sales. We have the online retail ETF ONLN from ProShares with $1 billion in assets under management. This ETF pinpoints retailers that mainly sell online or through other non-store channels, and it has a large focus on those that dominate the online retail space. We have the Emerging Markets Internet and E-commerce ETF EMQQ by Exchange Traded Concepts with $1.5 billion in assets under management. This ETF tracks an international index of leading internet and e-commerce companies. These include online retail, search engines, social networking, online video, e-payments, online gaming, and online travel. Lastly, we have the Global X e-commerce ETF EBIZ by Murray Asset Global Investments Company. This ETF invests in companies whose principal business is in operating e-commerce platforms, providing e-commerce software and services, and or selling goods and services online. This is the baby in the room with only $200 million in assets under management. So let's move on to portfolio composition. IBUY and ONLN are similar, with 75 to 80% of holdings being US based. However, IBUY has more European exposure and ONLN has more Chinese exposure at 20%. Spoiler alert, a lot of that is Alibaba. EBIZ has a bit more international exposure with only 55% US holdings and 24% Chinese exposure. As stated earlier in its title, EMQQ focuses on international non-US companies. The idea here being that while the US has had incredible growth in e-commerce, the rest of the world is expected to follow this trend. Only 60% of people in the world are currently online. EMQQ hopes to capitalize on the transition of the developing world. While international equities have historically trailed US equities, this trend could shift at any time. EMQQ is heavy with Asian exposure at 80%, 60% of that is China, which can be a turnoff for many investors, as investing in Chinese companies is very much subject to the whims of the Chinese Communist government. In spite of that, many of these are great companies which can make it worth the risk for many investors. So in short, IBUY and ONLN can be for those bullish on US online retail, EMQQ for those bullish on international online retail, and EBIZ somewhere in between. Let's take a look at market capitalization. IBUY is modified, equaled, weighted, and is therefore the most diversified across market cap. Only 32% of holdings are large cap. EMQQ is almost completely dominated by large caps at 95%. ONLN and EBIZ are market cap weighted and are somewhere in the middle with 50% large caps. Equal-weighted ETFs inherently have a buy high, sell low strategy, as they have to sell off the winners to buy more of the losers to maintain an equal weight. However, this can lead to more turnover and higher taxable events. Equal weight provides more diversification, but it can limit your exposure to some of the strongest performing names. Large caps are generally seen as safer, more stable investments that can better weather negative events because of their increased size and resources. Small caps are often seen as more volatile and risky, and with that, returns can be less consistent. However, small cap companies can be more nimble and can quicker capitalize on new trends to increase their growth potential. While small caps are more likely to get hit harder in a market crisis, they have attractive upside in the bull market that can make it worth the risk for many investors. Of course, these are generalizations and can vary on a case-by-case basis. Big is not always safe, small is not always risky. So let's take a look at the number of holdings in the weighting in the top 10. Given that iBuy is equal weighted, it's no surprise that it's the lowest weight in the top 10 names at only 23%. ONLN, EMQQ, and EBIZ are hovering in the 45 to 60% range. EMQQ has the most holdings at 125. iBuy is second at 75 holdings. ONLN and EBIZ are both in the 40s. So the top 10 holdings of iBuy tend to change a lot. Currently we have Revolve, Upwork, and Stitch Fix in there. Lots of smaller and up-and-coming online retailers in there. The top holdings of ONLN are very conventional and very much what you would think of when you think of online retail. We have Amazon, Alibaba, eBay, Etsy, and DoorDash. Also, Newegg recently got pumped to the moon courtesy of the apes over at Wall Street Bets, so we see it in the top 10. The most significant thing to point out is that Amazon and Alibaba combine to make up nearly 40% of the weight of ONLN. Amazon is currently 23%. Some might say, I love Amazon, this is no problem to me. Others might say, I already have so much exposure to Amazon and other ETFs. Maybe they own the Qs, consumer discretionary ETFs, growth ETFs, or maybe they just own the stock. Why would I pay a higher expense ratio for a specialty ETF that is so heavy in one company? Not to mention the concentration risk that comes with this. Moving on to EMQQ, no company is over 10%. We have companies such as Alibaba, Tencent, Mercado Libre, which is basically the South American Amazon, Baidu, and Sea. Looking at EBIZ, most of the top 10 are conventional household names. No company is over 5%. Williams-Sonoma, eBay, Shopify, Rakuten, and shameless plug, my Rakuten referral code is in the description. They give you cash back for everyday online purchases, and you can get $30 when you sign up and complete a purchase. So also we have Wayfair, Amazon, and GoDaddy. So in summary, iBuy may be for those seeking exposure to smaller up-and-coming retailers, EMQQ for those looking to cash in on the developing world's transition to e-commerce, and ONLN and EBIZ for those looking for more conventional exposure to, I guess you could say, the more blue chip online retailers, though I would say EBIZ is a bit more diversified of the two. So let's take a look at cost, and first with that, expense ratio, the annual percentage that we have to pay for management. iBuy is 0.65%, ONLN is 0.58%, EMQQ is 0.86%, and EBIZ is 0.5%. So on a $1,000 investment, iBuy would cost you $6.5 a year, ONLN would cost you $5.8, EMQQ 8.6 a year, and EBIZ $5 a year. So EBIZ is the expense ratio winner. EMQQ is borderline armed robbery. I'm kidding, but also not kidding. I don't want to sound like a cheapskate, but 0.86 is extremely high for a passively managed ETF. That's even higher than the 0.75 expense ratio that ARK Invest charges for active management, which of course requires much more work and research. Conventional wisdom tells us to buy low-cost diversified index funds and hold for the long term. Even the 0.5% of EBIZ may not sound like much, but there are S&P 500 ETF issuers that charge 0.03 or 0.04% annually, which is basically nothing. Granted, obviously they track a different index, but sometimes we got to be careful to not step over dollars to pick up pennies. Anyone that buys specialized ETFs like these, they're banking on outperformance that will well offset the small differences in cost. And the different exposure strategies of ETF can be much more significant than the small differences in cost. But small differences in cost can add up to large differences over time. You don't really think about it in the bull market, but it can be a real bummer in a bear market when your portfolio goes down or sideways and you're getting eaten into by fees. This calculator shows the concept. If you invest $6,000 a year into two ETFs, one with a 0.86% expense ratio and one with a 0.03% expense ratio, assuming equal returns of 6%, the 0.86 expense ratio will cost you $188,000 more over a 40-year period. But again, this assumes all other things are equal, which is a big assumption. So let's take a look at the spread cost of each ETF. Spread is the measure of liquidity and the cost of trading shares. Essentially the difference between the lowest ask price and the highest bid price. The lower the spread is, the lower the cost is to trade. Typically the larger a fund is and the larger the trading volume, the lower the spread. Also, large cap funds tend to have tighter spreads than small cap funds because there are usually more buyers and sellers for large cap stocks and so better liquidity. The average spread for iBuy is 0.12%, 0.08% for ONLN, 0.11% for EMQQ, and 0.15% for EBIZ. So even though iBuy has the highest average trading volume, ONLN still has a slight win, probably because of the higher concentration of more liquid large cap stocks than ONLN. But there's really nothing to worry about with any of these ETFs as they are all tight spreads. And this kind of liquidity is important for traders frequently moving large amounts of shares, but not as important for a buy and hold investor. So let's move on to performance. This comparison can be a bit messy because EBIZ and ONLN are newer. On average, IBUY outperformed both the NASDAQ 100 and the S&P 500 over a 5-year period with an average 5-year return of 37%. EMQQ underperformed the NASDAQ 100 but beat the S&P 500 with an average return of 20%. IBUY is also a winner over 3 years with an average return of 33%, compared to 26% for ONLN and 17% for EMQQ. The 1 year takes a closer look at the 2020 bull run that we had with the turn to online retail during the pandemic. On the 1 year, IBUY is up 56%, ONLN 36%, EMQQ is up 16%, and EBIZ is up 30%. So IBUY is also a clear winner on the 1 year. EMQQ is not looking so hot recently as Chinese stocks have been under fire recently. When I plot all of these ETFs since the inception of EBIZ, it is clear that IBUY is the overall winner on performance. So what are my thoughts? I certainly understand the argument that future growth is priced into these online retail ETFs as they had such a strong run during the stay-at-home environment. They may need to cool off for a bit in the short term. But in the long term, I would also argue that people formed increased habits of online shopping during the pandemic, and there is no going back. The switch from brick and mortar to online retail has been a long time trend, and I don't see it slowing down anytime soon. I personally own both IBUY and ONLN. However, I could certainly see myself transitioning away from ONLN to EBIZ for the sake of diversifying away from Amazon. Don't get me wrong, I love me some Amazon, but I already own the stock. I own it in growth ETFs, in the Qs, in the S&P 500, and in consumer discretionary ETFs. I don't necessarily need to pay a 0.58% expense ratio for more exposure to Amazon when all my other ETFs that own it are cheaper. I can see myself going 50-50 on IBUY and EBIZ. I buy because of the exposure to up-and-coming smaller and mid-cap names, and also the solid performance history. In EBIZ because it is more of a conventional online retail play with many of the well-known names in it. I see why many people would want to take the chance on EMQQ to try and capitalize on the online retail opportunities in the international markets. Also, owning international companies is a way to boost diversification. However, I personally am staying on the sidelines with this one. The expense ratio is a bit high, and international markets have a history of underperforming US markets. And again, this ETF has large exposure to Chinese companies, and while many of these are great companies, Chinese companies are always at the risk of the whims and crackdowns from the Chinese government, much like what is happening now. Even Cathie Wood is currently selling out of the Chinese companies, which says a lot because she's usually the first person to buy the dip. But again, some might argue that it's worth the risk. High risk, sometimes high rewards. Sometimes it can pay to be a contrarian and make purchases when everyone else is afraid to. In any case, I try to keep these kind of higher expense ratio specialty ETFs as a smaller part of my portfolio, and I keep my more core holdings as low cost and more diversified ETFs. I just dollar cost average and hold on. But if you found any of this helpful, please consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Currently, down there you can get 2 free stocks with Videvo, potentially valued up to $2,300, $30 with M1 Finance, a free stock with Robinhood, potentially valued at $225, and up to $250 with BlockFi, where you can earn interest on your crypto. As always, none of this is to be considered financial advice. It's for entertainment purposes only. Thanks, and I'll see you in the next video.